Hi, my name is Nick Sean Ambers, and I'm the Managing Director of Alpha Wealth. And basically, I'm going to spend the next 25 minutes or so just going through some really good financial tips as to how best to save, invest, and retire successfully, and helping you through the different stages of the financial cycle. I am joined by one of my colleagues today, Cliona O'Donoghue, who's the director of our business development, and Cliona will be looking after the Q&A function. So if anyone does have any questions, please do pop them into the chat and Cliona will address them. We are trying to make this as informative as possible. So please do feel free to ask any questions during the course of this, and we will have some time at the end to address them as well. And for those of you that are not familiar with Alpha Wealth, just to mention briefly that we're a progressive financial services company with our head office in Little Island in Cork. We have currently 11 employees, and we provide financial guidance for individuals at different stages of their financial cycle, also including their partners as well. So just to get into the main takeaways from today, there's really four main areas that I'd like to kind of discuss. Firstly, in respect of helping you to establish your financial goals and to reach them. Secondly, the biggest tax that we pay and the biggest expense is income tax and how to potentially try and mitigate against that. Thirdly, about getting your money to work harder. And then lastly, how to achieve what I call financial independence. This is this notion of being able to either change employment, go to semi-employment, or indeed retire fully. And this is a notion that I will talk a little bit more about as I go through this. So firstly, just in terms of financial goals, I always suggest, particularly at this time of year where we're in the first quarter, it's not a bad idea just to do a financial budgeter and try and work out what you're trying to achieve, not just for this year, but also in future years. And that way, it's really a good way of you trying to assess kind of where you are as a snapshot and how best to use the money that comes into the household appropriately. And this could entail things like, buying a property in the next number of years or do an extension, maybe helping fund forward towards children's education needs, or indeed just trying to become debt free. And it's really important, I think, for people to just assess on a yearly basis. And there's some really good tools that are available, free tools that we have on our own website, Alpha Wealth, that will enable you to do this quite efficiently. There's a financial budgeter, which I'll touch on in a second. And I think it's a really, really powerful tool that people should do at least once a year. This is the actual budgeter guides, and as I say, it's something that I always adhere to tell clients to do. The reason being is that so much changes. Even on recording this on the 4th of March 2025, conscious some of you may be listening to this on a recorded message, but there's a lot of news about stock markets falling yesterday on the back of the implementation of tariffs that Trump implemented last night. Now, whilst markets were half expecting this, they were a little bit disappointed by the effect, and hence markets took a bit of a downturn. And it has caused some people to be concerned about investments they have and indeed their own pension funds. But really, the main thing I would say to everybody on this call is just try and get an assessment of what your objectives are. And really, a lot of what I do is talk about balance in respect of making sure that you've got money in the right pots.
So Nick, before you move on, I've just shared the link to the budget calculator there in the webinar chat. But if you're looking at your gross income on a monthly basis, how much of that should you be aiming to save? Obviously, people will have bills and everything like that, mortgage payments. But, if you were to give kind of a guide, what would that be?
So as a standard, there's generally a rule that's used in the financial services industry called the 50-30-20 rule. And that means that typically you spend 50% of your net income, so this is your after-tax income, on certain fixed expenses like your mortgage or rent, childcare costs, and obviously fixed payments such as paying for things like groceries and so on. The 30% is the wants. This is the, spending on clothes and going out and the social events. And then the last 20% is allocated towards savings, whether that's towards, a short-term objective like buying a new car, or maybe medium term, such as helping children through college. And generally, as a rule, it works reasonably okay, but it doesn't always suit individuals. For example, let's say, for example, you're looking to buy a property in the next couple of years. Saving 20% of your income into a savings account may not necessarily be enough for your needs. And you have to kind of think about how you're going to sort of typically try and adapt that. And this goes back to what I was saying about trying to, assess what is it that's important to you. And more importantly for me is, and I talk about these three different pots, the short, medium, and long term, and really trying to sort of funnel your money appropriately. Yes, maybe along the lines of the 50, 30, 20 rule, but not necessarily so. And the key thing I'd say to everybody that's listened to this is whatever you're doing now and whatever you decide to do for the rest of the year, keep reevaluating. The most important thing I say to my clients is you have to have a check-in with preferably an independent person that can help you assess where you're aiming for and then how things may need to be slightly tweaked. So, for example, I talk about this short term being less than 3 years. The reason I say that is that if you're looking to save into something, let's say you're paying for your summer holiday this year, it's really important the type of instrument that you use. You can't invest that money. There's no point you trying to buy Bitcoin with a view to trying to make money in the next few months in order to pay for a holiday. That would not be prudent financial planning. In the same breath, if you're looking to save for the next 10 years, let's say, for example, for children's education needs, I myself have 4 children in a blended family, and I have them varying in ages from 20 down to 10. There's no point me saving into a bank account for their needs because typically for certainly the younger children, I feel that there's a much better opportunity to get better growth in more appropriate accounts. Long term, generally for most of us, tends to be pension planning, and typically that last third of our lives. I think it's really important to assess kind of where your pension pots are. I had a review with some clients earlier that are in a fairly decent financial position, but they had some previous pensions that they didn't have a clue where they were invested, and what to do with them. And I just suggested to them that it would be worthwhile allowing someone that's independent to review them for them and give them the most appropriate advice. So just to get a little bit more kind of into the detail, when I talk about short term, there's really simple solutions to this. We all got quite kind of lethargic over those years where the banks weren't paying any deposit interest. But that changed a couple of years ago with increase in interest rates and the introduction of Revolut to the Irish market. And what I say to everybody is that we should all be saving. Any employee of Arlo, if you have a partner, if they're working, try and allocate, even if it's a minimum amount of €10 a month, into a short-term savings account. And that specifically has to be in a bank, but you can earn 3% with the two pillar banks. AIB Bank of Ireland pay 3% on a gross amount every month with access. The only thing to watch for are terms and conditions, because like that, many people here may have a savings account with AIB or Bank of Ireland, but if they haven't basically restarted it every 12 months, their interest rate would have fallen down to 0.25%. For anyone that has money sitting in the bank that maybe requires that money for later in the year or for next year, for example, if you're looking to buy a car in January when the next registration plates come out, my advice would be to put it into a savings account, a deposit, but make sure that you're earning at least 2.83% interest. Why? Because there are banks out there, specifically Raisin being one example, which are an opportunity for all Irish savers and depositors. And you can see it on the screen there. There's a bank called Nordax, which most of you may not have heard of, that will pay you 2.83% with instant access, no fees, and they will pay you 2.83% for that money available on any given day.
So
And that's a
Nick, I'm going to
fantastic
jump in
opportunity.
here with another question, because yesterday there was an article in the news that said that Ireland is the third most expensive country to raise a child. Would these be good places to save for your children's future, whether it's their educational needs or whatever those costs may be? You know, are there other options? So let's say for somebody that has money saved maybe into the credit union or post office or bank, and they're looking for another option?
Yeah, it's a really good question. And again, if anyone has joined this webinar and has questions, please feel free to put them into the chat and we will address them towards the end. But it depends on how long you have. For example, if you've got a child who's 17, 18, and you need the money to pay for their next education fees, perhaps in September, you, yes, should be focused on the guaranteed fixed rates that I've spoken about. However, if you have younger children, and if you've got typically 3 to 5 years plus, for me specifically, I have two children in that category, then you can take advantage of higher interest accounts. I talk about the medium term being that three, typically to kind of retirement years, notionally 60 for most of us. So what I mean by that is that there's many of these accounts available through the insurance companies, the likes of Zurich, Aviva, Irish Life, and as independent brokers, we assess the best providers out there that can give you returns of 5, 6+% per annum. And the compounding effect of that over years is enormous. You can also place lump sums into these accounts. And what I like about them is that as long as you set them up at a low fee, and this is why it's really important to get advice, because some people may have these accounts already. They may have set up an Irish Life Saver or an account with Alcon Life, and their fees could be fairly horrendous, to be honest. So my advice would be find out what fees you're paying. Typically, you shouldn't be paying an entry fee and certainly not an exit fee. The other thing then is to assess what level of risk and reward on that scale that I put on the table there. The reason being is that the longer you have, the more risk you should be accepting of. For someone who's saving for 10 years, they should be in a slightly higher risk type of savings account than for someone who's saving for 5 years. And that's regardless of their own tolerance to risk. Now, when I talk about risk, guys, just to mention, let's take, for example, let's say the green bar on the screen, risk level 4. What that's telling you is that the returns typically available are about 5 to 10% per annum. Now, yes, it's possible to lose 5 to 10% in any given year. And before that turns anyone off, if you're looking at this over a 5 to 10 year time frame, I can assure you, and this is proven, that over any 5 year period, you would have made significantly more over that time frame in these types of accounts than you would have on a deposit. Now, obviously, as you get closer to the time that you require the funds, you de-risk. And the biggest mistake that a lot of people make, in my opinion, is that they don't maybe take advantage of these accounts, and then they don't realize that in the earlier years, you can accept the risks, similar to pensions, by the way. And then in later years, obviously, you start to scale back.
And Nick, obviously life is unpredictable and can throw, unexpected costs at people. So let's say, I know you said earlier in the last slide with the banks that you obviously have access to your money. What's the situation with access to your money in these accounts?
I'm a great believer of giving access to monies in all accounts. The reason being is that, as you said, the things change. And whilst I encourage people, if they go into these types of savings accounts in the likes of the insurance providers, that they have access. We set up something called the Alpha Savings and Investment Club, basically to make this easier for people to understand and obviously to benefit from. These accounts, we've basically selected the best ones in the market, providing them at the lowest fee, no entry fee, no exit fee, where you can start at a minimum contribution of 100 a month. It falls very well to anyone who has a child, putting the child allowance away, for example. You can put in a lump sum. The average returns has been north of 8% per annum, and we help you understand and manage the accounts. It's a very simple process, and we get obviously people to understand about these, what I call roadmaps, basically detailing how much money you could expect to make. For example, for any parent that is able to save the child allowance from the time that their child is born, that's the 140 euros a month. If you have an account that's earning about 4% net per annum, once you allow for the fee and any tax, that will give you a rate of about 40,000 by the time your child is 18. In my opinion, that's certainly sufficient to get them through college, and yes, probably beyond, and helping them get on to possibly the housing ladder. However, if you are leaving that money in, let's say, a 0% interest account, such as the credit union, and I'm really not a big fan of the credit union when it comes to deposits, They're fine if you want to borrow money, but if you're looking to save with them, they're telling you they don't want your savings, hence why they haven't increased their deposit rates. But your return would be in the region of about 25,000. It's so significant. And this is why I really, really encourage people, if you have the time, the 3 to 5 years plus, you should look at options outside of the banks. Just moving on to the long term. This is the kind of the third of the three pots that I mentioned. Obviously, as an employee of Arlo, you will be eligible to partake in the company pension scheme. And the key thing about pensions, in my opinion, are they're just as complicated as they may seem to be. Forget the fact that there's a lot of jargon in the industry. Just think about your pension as a great tax savings plan. Why is it great? Because you get typically 40% back on your payment if you're earning over 44,000 a year. However, if you're earning less than that, you still get 20% back. So for every 80 euros, it's brought up to 100. If you're on the lower rate of tax, and if you're on the higher rate, for every 60 euros, it's brought up to 100. The other main advantage of a pension is that it grows tax-free. And to me, that's significant. If you think about it, there's nothing else that you can put your money into. As good as these savings plans that I just spoke to you about, you will pay tax on the growth. That does not apply in your pension. And on the screen there's a lot of information, but just to break it down, people often ask me, like, how much would you need in your pension to be able to retire? Now, whilst that isn't a hard and fast answer, because obviously it would depend on when are you going to look to retire? Is it at 50, 55, 60? Because obviously if you retire earlier, you may need a little bit more, but also what type of lifestyle you require. But just to give it a context, the state pension in Ireland, which kicks in from 66, is worth on average about 250,000 euros, which might surprise some of you. But if you think about it, it's 14,000 a year. If you live for about 17 years, that will give you that type of amount of money. Now, in addition, if you can build up a private pension, that sort of brings you closer to a figure in and around 400,000 plus. So 150 is what would be required, tending slightly higher. The example I used on the screen there is 600,000. But again, that would include typically that 250 from the state. And the purpose of me showing you that is that what that would do is that would give you entitlement to roughly about a quarter of that fund tax-free, the remainder of which would give you an income of about 36,000 a year, which in my opinion should really satisfy most of us. Again, caveated by perhaps certain scenarios, perhaps including possibility of having another partner in the household who may have their own pension. But this is why making sure that you're getting advice and regularly checking it is really, really important, guys. And I don't expect anyone on this call to be an expert. The point being is it's about making sure that you are getting appropriate information.
So Nick, just on that, there's a question. Is it 10 full PRSI consecutive years or 10 years in total for the state pension?
It's 10 full consecutive PRSI years, but it can be made up of an amalgamation of partial years as well. Now, the rules have slightly been revised over the last couple of years, but generally speaking, if you have 10 full years of PRSI, you will typically be entitled to the full Irish state pension. And by the way, anybody who's listened to this, or if it applies to your partner, if you're listening to this in March of 2025, you do still have the ability to be able to claim UK state pension years going back to 2006. Now, not to get too ingrained in this, but if that does apply to anybody, please feel free to reach out to me. I am going to provide my contact details at the end of this call, and I can explain to you how easy it is to make sure that you put yourself on the system in order to be able to decide whether you want to partake in that. But the UK state pension is a huge opportunity, and we are providing specific advice. And I've worked in the UK myself. I'd be an expert in that area as to how it can really benefit individuals. And by the way, anyone who is an employer who hasn't joined the pension scheme, I cannot encourage you strongly enough to join the pension scheme. I presume it will only apply to maybe a very, very small minority. The only reason I'm saying this is that whilst I have no bias, I can give you independent guidance if you wish. The fact is, if you're not a member of the pension when the government introduced auto enrollment, which they are planning to in September this year, you will automatically go into this government auto enrollment pension, and it's not attractive for a variety of reasons. I've stated a few of them on the page there. It has no flexibility. You cannot access it before you're 66. And by the way, any company pensions can be accessed from the age of 50. So if you're an employee and you leave before your 50th birthday, or if you decide at 55 that you change jobs or want to take this partial retirement, as I spoke about, you can access your RLO pension and any previous pension schemes from different employments. And that in itself can be quite important, particularly if you're looking to pay down a loan or debt like a mortgage, or if you've got an aspiration to, do an extension, you could potentially use some of your previous pension pots. And this is why I say it's really important to get appropriate advice. There are different types of fund options out there, and you should really get some information and advice from someone. Now, on the screen there, I've just given you 4 variations. Now, again, these are different fund managers, but just to show you that even with the same risk category, all these funds that I put on the screen there are equally the same in terms of their risk profile. But you can see there's a massive variation. The Zurich one being the highest currently, but you can see Standard Life, for example, they have a fund which is a medium high risk fund that has done dismally poorly. The fact is that it just shows that, it's really important just to make sure that you're in the right fund for you. I
And
just want to touch
sorry,
on,
before you move on,
go
just
on.
from the pensions, is there, I know you mentioned on a previous, like just in terms of like an aim for how much should you have in a pension? Is 600,000, I mean, it seems like a lot of money. Can you survive on less than 600,000?
Yeah, you can. I mean, it doesn't have to be just your pension. I mean, many people may have another source of income. They may have a investment property. They may have savings. And by the way, the 600,000 includes that 250 from the state. So really it's 350 ideally. And yes, I would be suggesting that the aim for most of us is to try and get as close as we can to 350 in private provisions. Because obviously the reason for me saying that is that would bring you to that sort of 36,000 a year income, which in addition to the tax-free lump sum would bring you to that threshold of paying tax at the higher rate, once you allow for maybe any other kind of part-time, roles, or perhaps giving your tax credits to your partner. So look, this is not, and again, the average pension in Ireland is relatively moderate. Most private pensions might surprise you are probably about 150,000 euros. But the point being is that it's about understanding that if you can try and start as early as possible, and it's not about, we should have started 10 years ago. Today is the earliest day that you can make any decision around what you may want to do. But just remember, guys, that paying extra into your pension scheme from a bonus, a pay rise, or indeed the tax credit adjustment that was made in January from the budget last October, every 60 euros will bring your pension up by 100. If you're a lower rate taxpayer, obviously it's 80. That in itself makes a hell of a lot of sense. And even if you only do it for a short period, it's definitely worthwhile. And I have no bias, and I'm strongly recommending that this would be something I would
And
encourage you to do.
with previous pensions, like obviously there is a lot of movement in the, I suppose, workforce now, and people may not, be in the same role forever and may change companies or may have worked in a previous company. But if they have an old pension, like what is the best thing to do with it? Do you leave it sitting where it is, or do you bring it to the new employment, or what are the options and what's the best option?
So firstly, you shouldn't just ignore the fact that you've got this pension scheme. And I always say to people that it's a really easy process for a financial planner to get details and typically go directly to the provider. So whether it's with Aon Hewitt, Mercer, Irish Life, or whomever, that's the process that we do on behalf of our clients. The second thing is, should you bring it into your new employment? No. Why? Because generally it's better to have 2 pensions rather than one. The reason being is that it's better to have the flexibility of being able to draw down one of your pensions, let's say earlier, for one of the purposes I mentioned, or indeed phase your retirement, where the notion now is that most of us are probably not just going to stop working on one given day. It's this example of kind of this partial retirement where we draw one pension on a lower income that we're on. We continue, maybe draw a second pension, and so on. But again, the point being is that they need to be managed. And this is the thing, make sure it's in the best possible pension pot. And this is where we can advise you. Just, I'm conscious of time as well. And again, if anyone does have questions, please do put them into the chat and we will address them. But I just want to touch on a couple of quick areas here as well. Mortgages. We are an independent agent to give advice on mortgages. We do not provide them directly, and we've deliberately stayed out the market in order for us to be independent. And really what I'd say to anybody who has a mortgage is that it's really important to know what interest rate you're paying first and foremost. Why is that important? It's because it's an understanding of the fact that interest rates went up quite a lot over the last couple of years, and now they've started to fall. And depending on when you find yourself, you could be on an expensive mortgage, or you could be on a cheap mortgage, i.e. a rate of less than 3%, for example, where you could be up for renewal in the next year or two, and you just need to kind of know how best to navigate. The thing I always say to people is speak to your current mortgage provider and just get a sense of what your options are. For example, if someone was on a mortgage rate of over 3.5%, I would fix that now with my provider. If someone's looking to get a mortgage in the next while, make sure that you speak to a mortgage broker. Why? Because it will be better than speaking to your own bank, for the fact that there's 7 mortgage providers out there and your own bank may not be the best of them. But the key thing is just to keep reassessing and not this kind of like leave it until such a time that I have to do something. And there's no cost in speaking to your current mortgage provider. And it's just an exercise that I would suggest you do, particularly if you're in a higher rate, or indeed if you're coming off a fixed rate. We are expecting 2 more rate cuts this year. And again, it's really important to sort of navigate. But for anyone's paying over 3% on their mortgage, they've got an opportunity to go back to their lender and get it refixed now. The other thing is then you're forced to take out 2 insurances when you have a mortgage. One of them is house insurance. Make sure you review that every year. It's not a product that we provide, but certainly I would suggest that you could use a general insurance broker, and we can provide you with the best ones that we feel would save you money without bias. The other then is mortgage protection. This is the life policy that we're all forced to take out when we take out a mortgage. And I've seen so many people, guys, that spend way over the odds for this, because when they took out their mortgage, they were brought into a back room. I used to be that person working for AIB for many years, and they signed up to a policy just to get out the room. And a lot of people are paying way over 25 euros a month for it. And in my professional opinion, and I have 27 years of experience in this area, I think that most of us should be spending less than 25 euros a month. Now, I carry that by saying this is on the presumption that you're a non-smoker. And again, it depends on obviously how much you borrowed. But one thing I would say to you, make sure you get someone to review it, because you can get out of that mortgage protection policy on any given day. You do not have to wait for a renewal date. There is no renewal date per se, but just make sure you're not paying more than you should. Really an easy way to save money. On one other area in terms of reducing tax, pensions obviously being one of the main ones. Jack Chambers, the finance minister, said there 2 months ago that there are millions of euros that can be claimed back by Irish taxpayers that aren't every year. And they're actually encouraging people in revenue. They've actually done some recent talks to try and get people to understand that using the revenue online system known as ros.ie is really simple. Honestly, it's something that I can't encourage everybody on this call to take advantage of, because if you're renting, there's a rental tax credit. Over 50% of people still haven't claimed it, which is incredible given the fact that it's worth several thousand to most people out there. Anyone who's working from home currently or has worked from home in the last 4 years, you can claim a working from home relief up to 30% of expenses like heating, phone, and utility bill. And yet most people still haven't claimed them, which is, incredible. Some people, I believe, feel there's probably quite a lot of work. It isn't. I can say that definitively. And some people are perhaps worried about bringing revenue upon them. And I'd say to you that in the 27 years that I've done a tax reclaim, I've got tax back in every single one of them. And I can't encourage you but to use it. Really simple. Again, I will send on details later on. including the slides from today. But just go on to the account on ross.ie, set it up within 2 minutes, and take advantage of making sure that you're claiming back. And you can go back 4 years as well, guys. So it's really, again, something that could potentially get back quite a significant amount of money to you. I just want to finish off on saying about, the whole concept of saving and investing. Now, again, sometimes the word investing has connotations about risk. It doesn't have to. By the way, there are guaranteed investment options out there. The key thing is to recognize that your money needs to be earning at least 2% a year, wherever it is. Otherwise, you're going to lose money to inflation. Obviously, longer term savings like pensions, like the types of savings accounts like the Alpha Savings Club that I mentioned, they can give you potentially a much greater return. And it's more about an understanding of where you are on that cycle and really what you're trying to achieve. We always provide projections for our clients. I call them roadmaps, whether it be for children's education, for retirement planning, and so on. And it's a really simple and easy process. Just to mention as well, we are doing a series of webinars. They're completely free. You can sign up for them on our website, or indeed, if you have access to the QR code there on the screen. The next webinars that are coming up are on the 13th of March, which again, I appreciate anyone listening to this after that date may have missed, but you can go back and listen to them on our website, or indeed register for them and we will send you the video. One of the webinars that I'm doing myself on the 27th of March is in relation to this concept of how can I retire early? What's the best way that I can put myself in a position to understand and to recognize, what does that look like and how to actually achieve it? We provide a consultation process in Alpha Wealth, which basically gives you an ability to sign up for a fixed cost of 199 euros. Whether you are a platinum or a core person, we will reduce the cost to 199 for you, where we provide a service of a full consultation based on a 1 hour review. Having got information in advance doesn't take you a lot to provide that. We assess your position. I send you information in relation to, things that I feel would be beneficial to you, and helping you on an ongoing basis with no further fee to make sure that you're managing your finances appropriately. And this incorporates many meetings if needed, and also a partner if relevant. So I think it's a really valuable service, but again, it's totally up to you. But if you have any questions, please ask them now. Or indeed, you can email me. My email address is on the screen there, info@alphawealth.ie, or nick@alphawealth.ie if you prefer. And we'll answer any questions you have at zero cost to yourselves. The purpose of the financial review, guys, is really to give you that sort of sense of, okay, this is where you are now, and this is basically giving you an impression about how can you retire early successfully, how can you make sure your money's working, how can you reduce debt, how can you make sure you're paying the minimum amount for insurances. Great. Well, thank you very much again for your attendance today. And anyone who's listened to this recorded who would like to get in touch, obviously, as I said, please feel free to drop me an email. Or indeed, if anyone would like to sign up for a consultation, again, with no obligation to take advice and no further fee, please feel free to do so. Again, you can do that through our website or indeed on the QR code there on the screen. Thank you very much again for your participation, and I hope you enjoy the rest of the day. Thank